Stock market crashes, housing market booms. Where should you put your money to work? Real estate or stocks? Let's break it down, because the answer might not be what you expect. Every year, millions of people debate whether to put their money in real estate or the stock market. Both have huge potential for growth, but they also come with their own risks. In this video, we're going to dive into the differences, pros, and cons of real estate investing versus stock market investing. By the end, you'll know exactly where you should be focusing your energy to grow your wealth, and I'll share the 3 biggest advantages of real estate investing that most people overlook. Whether you're a beginner or experienced investor, this breakdown will help you make a smarter decision with your money. People love to talk about investing. You've probably heard that stocks are the easiest way to grow your wealth, while real estate is a more stable and hands-on approach. But how do you really decide which is the best for you? Do you trust the stock market with its unpredictable crashes and booms? Or do you go with the seemingly safer option of real estate where you're tied down to physical property? The problem is, choosing the right path is tough, especially when both options seem to have their own unique advantages. Real estate requires more upfront investment and maintenance, while the stock market can feel like a gamble with crashes and booms you can't control. It's overwhelming, and for someone just starting out, there's a lot of confusion about which route will truly lead to the best returns. Let's start with the stock market. For many people, investing in stocks is the first thing that comes to mind when they think of growing their wealth. One of the main reasons people flock to stocks is the ease of entry. Unlike real estate, which requires a significant upfront investment, you can begin investing in the stock market with as little as $10, $50, or even less. You don't need a ton of capital, which makes it an attractive option for people just getting started. The biggest draw to stock market investing is its liquidity. Liquidity refers to how easily an asset can be bought or sold. When you invest in stocks, you can buy or sell shares in a matter of minutes. In contrast, real estate isn't liquid. You can't just sell a property in an instant. If you need to access cash quickly, stocks give you that flexibility. Stock investing is also highly accessible. You can purchase stocks from any company across the world without ever leaving your house. Apps like Robinhood, Trade, and others have made investing as easy as clicking a button. Furthermore, you don't need to be an expert to start investing. There are plenty of online resources, courses, and tools that make it easy to understand how to invest in stocks. And let's not forget about diversification. One of the key strategies for managing risk in the stock market is spreading your investments across different sectors, industries, or even countries. Instead of putting all your money into a single stock, you can buy into a diverse range of companies, which reduces your exposure to a single company's risk. With tools like ETFs, exchange-traded funds, and index funds, you can get instant diversification for a low cost. But here's the flip side. While the stock market is relatively accessible, it's not without its challenges. The most glaring issue is volatility. Stocks can fluctuate in value significantly within a short period of time. The price of a single share can go up by 10% one day and drop by 15% the next. This makes stocks a great option for those who are comfortable with high levels of risk and are prepared to weather the storm when market crashes occur. For example, the 2008 financial crisis sent stock prices plummeting, wiping out billions in market value. Many people lost a significant portion of their wealth in the span of just a few months. The fact is, while stocks can give you great returns, they can also take them away just as quickly. Investors who bought stocks during the market peak in 2007 saw their investments lose 40% of their value by the following year. Even the COVID-19 pandemic caused massive market swings in early 2020. The stock market can also be difficult to predict. Even if you follow the news, keep up with earnings reports, and monitor trends, there's always uncertainty. Some experts argue that stock market returns are highly dependent on timing. If you get in at the wrong time or sell too early, you could end up losing money. Additionally, stock market returns aren't guaranteed. While the stock market has historically shown a long-term upward trend, there are periods of stagnation or even decline that can be difficult to recover from. For instance, between 2000 and 2010, the S&P 500 delivered 0 returns. That means that even though you were invested in a diversified index fund, your portfolio grew by essentially nothing for an entire decade. While stock investing is appealing for its ease and liquidity, it's important to recognize that it also requires patience, knowledge, and the ability to stomach risk. It's not a get-rich-quick strategy, and for some people, the constant fluctuations can be a source of stress. Now, let's talk about real estate. Real estate investing is a whole different ballgame. The most significant difference is that real estate is a tangible asset. When you invest in real estate, you're purchasing something you can physically see and touch. There's a level of security in knowing that your money is invested in property you can walk through. It's not just a piece of paper or a number on a screen. Real estate is a real, solid asset. One of the biggest advantages of real estate investing is control. Unlike stocks, where your returns are largely dependent on the company's performance, real estate allows you to influence your investment's value. You can renovate a property, improve its condition, and increase its rental income potential. If you buy an undervalued property in need of repairs, you can add value by fixing it up and selling it for a higher price or renting it out for a better return. Real estate also offers the potential for steady cash flow. One of the most attractive aspects of real estate is the opportunity to create passive income. If you invest in rental properties, you can earn monthly rental income from tenants. In some cases, that rental income could cover your mortgage and other expenses, and the property might generate positive cash flow, meaning you're earning money every month. Stocks typically don't provide that same kind of reliable, predictable cash flow unless you're actively trading or investing in dividend-paying stocks. Additionally, real estate offers appreciation potential. Over time, properties tend to increase in value, especially if they're in a good location. For instance, if you bought a home in a rapidly developing neighborhood, you might see your property's value increase significantly over the years. Even if the market dips temporarily, as long as you hold on to the property long enough, you're likely to see long-term growth. But real estate isn't without its challenges. First of all, it's much less liquid than stocks. If you need to sell a property, it can take weeks or months to find a buyer, and you might have to reduce the price in order to sell quickly. Unlike stocks, which can be sold in minutes, you can't just cash out of real estate when you need the money. Moreover, real estate requires more work and hands-on management. If you own rental properties, you're responsible for maintaining the property, dealing with tenants, handling repairs, and ensuring the property stays in good condition. If you're not experienced in property management, this can be time-consuming and stressful. You'll also need to have a good understanding of the local market, property laws, and tenant rights to avoid costly mistakes. The initial investment required for real estate can also be a barrier for many people. Unlike stocks, where you can start with just a few dollars, buying a property typically requires a down payment of 20% or more. Plus, you'll need to cover closing costs, inspections, insurance, and any initial repairs. If you're financing the property with a mortgage, you'll also be responsible for monthly payments. Leverage is another powerful tool in real estate investing. In simple terms, leverage is using other people's money to increase your potential return on investment. If you put down 20% to buy a $100,000 property, you're controlling an asset worth $100,000 with just $20,000 of your own money. If the property appreciates by 10%, you'll make $10,000, but you'll have done so with a relatively small upfront investment. This kind of leverage doesn't exist in the stock market, where you can't borrow money to buy more stocks without paying hefty interest rates. Another key advantage is the tax benefits associated with real estate. Unlike stocks, which are subject to capital gains taxes, real estate investments come with opportunities for tax deductions. Mortgage interest, property taxes, repairs, and depreciation can all be deducted from your taxable income. This means that owning real estate can lower your overall tax burden and increase your cash flow. Here's the big twist. Real estate isn't just for those who want a safe bet. In fact, real estate can provide you with better returns than stocks over time if done right. Think about it. Property appreciates over time, and you can earn passive income through rent. If you buy in the right location, your property can see massive gains, and you can add value through renovations. Sure, there are risks, but when you look at the numbers, real estate often outperforms the stock market in terms of stability and long-term gains. For example, since 1987, the average annual return for real estate has been around 8.6%, while the stock market has averaged about 7%, but with far more volatility. So, the question is, are you in it for fast profits, or are you looking to build long-term wealth? At the end of the day, both real estate and the stock market have their pros and cons, and the right choice depends on your personal goals, risk tolerance, and the time you're willing to commit. If you're someone who wants a fast, liquid, and hands-off approach, then the stock market might be for you. But if you're looking for stability, long-term growth, and a tangible asset that you can control, real estate may just be the way to go. For me, the case for real estate is clear, and here are the 3 biggest advantages that make it stand out. Tangible asset. Unlike stocks, real estate is a physical asset. You can see it, touch it, and even improve it. You have control over your investment, from maintenance to deciding how it's used. If the stock market crashes, you still have the property in your hands, which isn't always the case with paper investments. Cash flow potential. Through rental income, you can create a stream of cash flow. This is something the stock market can't always offer unless you're actively trading. If you own rental properties, you can rely on consistent income month after month, which adds stability to your financial plan. Tax benefits. Real estate investors often enjoy tax breaks, including deductions for mortgage interest, property taxes, and depreciation, which can help lower your taxable income. Additionally, long-term capital gains taxes on property can be much lower than short-term gains from stock market investments. Unlike stock investment, which is just a numbers game, real estate, which holds tangible assets, holds dreams and romance. There's something about owning property that resonates on a deeper level. It's about building a legacy, having a place to call your own, and yes, even creating a bit of history. While stocks can be traded at the click of a button, real estate is about creating something lasting and meaningful. You can walk into your property and feel its potential, its growth, and its ability to bring financial security. If you found this video helpful, make sure to subscribe and stay updated on the latest real estate trends that can help you make smarter investment decisions.